Welcome to Get Rich, the podcast that helps you do just that. Get rich and stay rich. Hey, I'm Briony Benjamin. I'm the founder of Ladies Finance Club, one of Australia's largest financial education platforms for women. But before I started helping thousands of women take control with their money, I was a hot financial mess when it came to my own finances. And not the fun kind of hot, more like crying in a supermarket wondering where all my money went kind of hot. But here's the thing, if I can go from financial mess to owning a share portfolio, investing in property and building wealth, then you can too. My mission is simple, to make women rich. Because when we have financial freedom, we have choices, confidence, and control over our future. Every week on Get Rich, I sit down with some of the best experts in the industry to break down how we can all start investing, growing our money, and creating long-term financial security without the jargon, boring bits, or overwhelm. Because when women get rich, we don't just change our lives, we change the world. So if you're ready to start making some smart money moves, hit that subscribe button and let's get rich together.
Hey everyone, it's Briony Benjamin here. I'm Molly's big sister and I'm filling in for Molly while she's off in newborn land. So today we're talking investing without the jargon, without the fear, and I'm going to be joined by the brilliant Jessica Leung. She's an ETF portfolio manager and the creator of The Long Way. You can follow along on Instagram. She's all about making investing simple and accessible, which was what Ladies Finance Club is all about. We cover what investing actually is, why saving alone isn't enough, how compounding works, and how to get started even with small amounts. Plus, ETFs, diversification, ethical investing, and the biggest beginner mistakes to avoid. If you've been thinking, I should really start investing, this is your sign. Let's get into it. Well, we are pumped to have Jessica Leung on the line today to teach us everything we need to know about investing. Jess, you are the guru, and I'm so excited to have this chat with you. So thanks for making the time.
Thanks for having me. I'm so excited to be here.
So Jess, to get straight into it, just nice and simple, no jargon, no financy speak that people often get stuck in. What is investing?
Yeah, so to put very simply, investing is putting your money to work so that you can grow over time. So instead of money just sitting in your bank account, kind of earning interest, investing puts your money to work by giving you exposure to things that can potentially increase in value over the long term. So for example, like shares, companies, properties, or bonds. And remember, the goal isn't to get rich overnight. When it comes to investing, it's to build wealth steadily and sustainably over the long term.
Well, that sounds pretty good to me. I don't want my dollars sitting around being lazy in the bank account. So I love that idea that it's actually putting them to work. And just why? Why is that important though? Why aren't savings alone enough?
Don't get me wrong, saving is super important, and that's always the first step that we tell people when they're starting investing is to always save up an emergency fund. But saving gives you safety and flexibility. But the reality is, unfortunately, is that saving alone usually isn't enough to build long-term wealth. And why is that? It's cost of living, right? So everything keeps going up, and then so that the interest rate you earn might not necessarily be as much as the rate at which cost of living is going up, so you can't keep up. So investing gives your money the chance and the potential to grow faster than inflation over time. And investing is really what gets you from, just getting by. You're saving your hard-earned dollars into your savings account and you see it slowly increasing over time versus actually building financial freedom and long-term wealth. So both saving and investing matter. They just often serve different purposes. And I think since we're talking about investing, we have to talk about risk as it's, two sides of the same coin. So you can make money by investing, but on the flip side, you can also lose money by investing. So which is why it's so important, and we often talk about understanding your personal investment goals. So what is it that you want to achieve from your investments, and also your risk profile. So how much risk can you take on, and how much risk do you want to take on, and then choose your investments accordingly. So that's why, when you save, well, then you're probably thinking, why shouldn't I just save if there's risk? Well, saving isn't exactly risk-free when it comes to thinking about it in terms of building your long-term wealth. I like to think of it as risk and return lie on a spectrum. So saving is on the very far end, where it's highly unlikely that you'll lose money, so it's very low risk, but then at the same time, the rate of return is more on the lower side, and it's often not enough to keep up with inflation. So that's why you need to consider investing alongside saving.
Right. Okay. So if the money's just sitting there in your bank, it's pretty safe on the spectrum, as you said, but it's actually due to inflation, as you were saying, sort of like it's almost getting eaten away, like you're almost going a bit backwards, would you say?
Exactly. So let's just say inflation has been like 6%, while your interest on your savings account is probably 5%. So even though you're earning the 5% every single year, you're still essentially losing off that 2% because the rate at which prices and the cost of living is increasing is just higher.
Yeah, right. So, okay, that makes it really clear as to why investing is so important. But as you say, people might like the safety of having the savings there, and you're saying that's good to have in the mix. So how do we move people beyond, I suppose, that fear mindset of I'm just scared of investing. I don't know where to sort of begin. What do you say to people?
Yeah. So that's why we always go back, like I mentioned, to understanding personal finance is personal, right? So it's really asking yourself those deep down questions on what is it that you want to achieve over the long term. Do you want to buy a house, or do you want to build your nest egg, or do you want to save for a holiday, or do you want to do it all? And there's absolutely nothing wrong with that, right? But it's just getting very clear with yourself in terms of what you want to achieve and in what time horizon, because that will help determine what type of investments you have. And then understanding, well, how much money can I afford to invest every single month or whenever you get your paycheck? And then also understanding what's the appropriate risk profile for me. So how much risk can I afford to take on? So then, for example, if I want to save up for a house one day, is it just enough to put it in my savings account? Or on the flip side, should I put it into something really risky? For example, like crypto futures, leverage, all that kind of stuff. Is that the best choice for that specific goal? So then after you kind of ask yourself those questions, it helps take the emotion out of it a bit. And then you get more comfort in knowing that you're doing something which is risk adjusted and which is helping you achieve your long-term goals.
Okay, fantastic. Jess, I often hear this term about compound interest and that it's the eighth wonder of the world, people say. But why and how? And can you just give our listeners an example of, how that works in actuality?
Yeah, so compounding in essence is where your money starts to earn money on top of the money it's already kind of earned. So there's a lot of on top, on top, on top. So to visualize it, think of it like the snowball, rolling down the hill. At first, it starts very small, but then through time, as it compounds, it gathers more and more. And then through that gathering, then it'll keep getting more traction. So that is what compounding. So at the beginning, it might feel slow, almost boring at times because you don't really see much action happening. But over time, the gains really start building on themselves. And that's really when the real magic and the acceleration happens. So that's why in investing, we say it's not about timing the market, it's about time in the market. So the longer your money is invested, the more powerful compounding becomes. And then that's why we call it the eighth wonder of the world.
Okay, I love that. I'm thinking of my money as a giant snowball just rolling on down the hill.
The best thing is at the end, you don't need to do anything, right? You're just watching it falling and it just keeps compounding and growing. And that's why it's so magical.
Okay, fantastic. And you said a really interesting line there about it's not timing the market, it's time in the market. So I know for me, I was actually bought a bunch of shares when I was in high school, and you didn't have as many bills as maybe I have now. And I've sort of sat there ever since, and it's been on my to-do list to buy more shares to do it. But there's often those, things are crazy in the world right now, or the economy feels unstable, or, and so you are trying to wait for that moment. Yeah, what would you say to people, beginners that are thinking, I want to get started, but it's just not the right time? How do I know when that right time?
Yeah, so I would say there never is a right time. As the saying goes, the best time was probably yesterday or 10, 15 years ago, but the second best time is right now. So I think once you've kind of got the foundations right in terms of you've got your emergency fund set up, you've paid off your high interest debt, you've done your budget, you know how much you can actually afford to invest. So making sure you're investing with funds that you don't need straight away or over the short to medium term horizon, then now is as great a time as ever to start investing. And then that's why I always come back to what is your goal? What is your investment plan? Because then that helps take the emotion out of everything. And then there's been lots of research and studies showing that just by missing the best 10 days of performance, that will have a substantial impact on your portfolio over the long term, as opposed to you just staying invested and going for the ride for the long term.
Yeah, fantastic. And Jess, what for people that are beginning out in their investing journey, what are some of the biggest myths that you think stop people from even getting started on that journey?
Yeah, so one of the top ones that I always hear is that, oh, investing is really risky. It's practically just gambling. But to that, I would say, like, if you're a high frequency trader or if you're speculating, that's what gambling is, right? But if you're investing for the long term, appropriate to your risk profile in a diversified portfolio, then that is investing for the long term, and that's not gambling. And the second one is I'll start when I have more money, and that's what keep people stuck for years. But like we mentioned with compounding, it's you just got to start and take small steps, and then once you start consistently taking those steps, then compounding and the rest will work itself out to help build your wealth over the long term. And last one, so this one's a bit cheeky. I'm not sure if I should share it, but often when I talk with like my girlfriends and whatnot, they always just say, "Oh, I'll just let my partner handle the finances. He's the one that invests it." And to that, I always say, a man is not a plan, or it doesn't matter, a man or woman is not a plan, right?
Yes.
It's like, so, so that's why I find financial literacy really empowering because it gives you financial independence, confidence, and freedom. And I mean, who doesn't want that? And at the end of the day, it's your hard-earned money. So that's personally why I started my social media to help, educate on all things investing and ETFs. And that's also why I'm such a big fan and advocate of communities like yourself, Ladies Finance Club, to help break down the barriers and jargon and to actually explore how do you start investing in a practical manner.
And I was actually wondering that, Jess, where did you first get interested in the world of investing? I mean, at what age were you like, this sounds like a good thing I should be across?
So my kind of origin story started when I was really young. My first memory of investing kind of goes back to year 3, and that was when we had a substitute teacher, and she came in. So this is showing my age now, but then she gave us all photocopies of the newspaper because back then that's where all the share prices would get printed. We didn't have mobile phones that were updating live prices, so we just got this massive photocopy of all the stocks on the ASX, and we were given this mini assignment going, okay, you have $10,000 to invest. How would you invest it? So then we kind of went through the whole exercise of choosing our own stocks and had a paper portfolio, and then we would track it throughout time. So that was my first ever memory when it comes to investing.
What a wonderful way to get started. And I remember doing a very similar thing with my mum and dad, like highlighting the ASX numbers and going through it and getting your head around it. And what a gift at that age to get across it. So sounds like a great substitute lesson you had there. Got you started.
Yeah.
If
I mean,
she could
I
see you
owe it
now.
all to her. So.
So Jess, if someone's never invested before, where do you start? What's step one?
So step 1 is actually step 0, and it's actually got nothing to do with investing. Like I've mentioned before, it's really about getting your foundations right. So that's why I call it step 0. And what that means is make sure you have an emergency fund saved up. So that would be 3 to 6 months of your usual living expenses, or depending on your personal circumstances, just in case if anything touch wood happens, you do have that emergency fund to fall back on. Pay down any high interest debt, and then budget. So like I mentioned before, it's very important that you only invest with the funds that you can afford to invest with. So even if that means after you're doing your budget, you've allocated all your different money and you only have, let's say, even $50 or $100 to start, that's more than enough because there's lots of micro investing apps. So that's where I would plan on starting.
Okay, fantastic. So I know Molly always calls it at Ladies Finance Club an OMG fund. So have your OMG fund sorted for those OMG moments of life, pay down any bad debt, sort your budget, but don't be afraid to start small. It doesn't matter if you don't have thousands of dollars to invest. You can start, as you said, with a very small amount.
And I think it's better to start small because imagine if you go all in on day one and then like we said, that's volatility, that's risk. It's not always up, up, up. It's like up, down, but investing over the long term tends to be up. So then imagine if you just put your life savings in on day one, this is your first time investing, and then you see the stock market goes down 2% the next day. Like that would be a quite traumatic and horrific experience. So if anything, I always believe in like you learn more on the job as opposed to just reading on textbook. And so that's why you start small, get in the process of investing, getting familiar with it. And then so that by the time your savings and your investing grows to a substantial amount, you're very familiar and confident with the whole investing process.
Okay, fantastic. That sounds like my style of investing for sure. And Jess, this term is bandied around in investing land, an ETF, but what actually is it? Can you just break it down really simply?
Sure. So ETF stands for Exchange Traded Fund. And how I like to break it down is actually backwards. So it is a fund, which is essentially just a pool of money gathered from all the investors into one that is traded on the exchange. So on the exchange being the ASX. So my analogy of how I like to think about an ETF is the party mix of securities. So I know Molly likes to use the favorite box of chocolates, but I'm more of a sugar and a lolly girl compared to a chocolate girl. So I always do the party mix, the Allen's red bag of party mix. So within the one bag, it gives you exposure potentially to hundreds of companies, an entire stock market, or a specific theme. So taking our A300 or the Australia 300 ETF as an example. So within that one ETF, it gives you exposure to the largest 300 companies listed on the ASX. So instead of you individually going to buy red fog, so like BHP and then, the snakes, CBA and NAB and Westpac and so on to curate your own kind of basket of securities, you can get exposure to all the 300 companies within the one product.
Fantastic. Well, I'm craving some red frogs now. Thanks for that, Jess. But a great way of thinking about it. So you don't want to overdose on red frogs. And like you said, they could be pretty volatile, but you get a bit of everything. And therefore it's like a safer way to invest, I suppose. And that diversification, why is it so important? I mean, you touched on it, but can you go into that in a little more depth?
Of course. So the benefits of diversification, as the saying goes, is to not put all your eggs within one basket. So when you spread your money across different investments, across different names, you reduce the impact of any one single investment doing poorly. So let's just say you had everything in CBA and CBA was down 5%, then your whole stock portfolio was down. But if it was spread across hundreds of different names and each of them had separate performances, then you get a much more balanced, diversified return when it comes to your portfolio. So, but I do have to say, it doesn't totally eliminate the risk altogether because there's no such thing as a free lunch. It just helps smooth the journey along the way. And because investing, we can't control the markets or their performance, but what we can control is how concentrated or diversified we are.
Okay, fantastic. And so any other pros and cons for us of buying individual shares versus that ETF?
Yeah, so then like we have already mentioned, so within the main benefits of an ETF is that you get diversification. So you get that access to the whole lolly bag of securities within the one product. Another benefit is that you can buy in or out of it just like you would any share on the ASX. And that is usually on the hours of 10 to 4, Monday to Friday. They're also low cost. So what we mean by low cost is taking that A300 ETF as an example. So A300 is the ticker code. Imagine you having to buy each of the 300 names individually. So you have to buy brokerage. That means you have to spend brokerage on 300 names and then try to combine everything. Whereas in this one, you just have to pay the one set of brokerage because you're just buying that one product, which gives you exposure to the whole 300 names. Other ones is, like I mentioned, ease of trading. So just like you would a share, and then transparency. So as a passive ETF issuer, we have to list all our holdings on our website every single day. So you can have a lot of comfort in knowing that every time you log onto our website, you know exactly what your ETF is holding.
Fantastic. I suppose for some people, it might not be quite as exciting buying an ETF. It might be a bit more boring than being, I've bought, shares in this crazy cool new startup. I know you often hear really experienced investors say boring is beautiful, boring is great. Why is that the case?
Yeah, so when it comes to investing, it all really depends on your personal preferences. So I remember kind of going back to year 3 or then when I started actually investing with my own money as I was younger, but not as young as when I was in year 3. I used to be, very hardcore in terms of I want to be a stock picker. But what does that mean when you invest in shares versus an ETF? Is that it's a lot more concentrated because everything is in that one name, and it often requires so much more work in terms of research and whatnot. And adulting is hard. As of now, I can barely have my life together, do my budget, do the laundry, let alone thinking about what stocks to consistently invest in. So that's why for me, there's a lot less mental load when it comes to investing via a diversified ETF. And I just find that approach works for me the best.
Okay, fantastic. Well, I know that at the moment, at this point in my life, with two small babies and all the things going on, it just feels like one more thing to do. So to be able to simplify it and
Exactly.
make it easy is very high up on my list of things I'm looking for. That's for sure.
And now I even just set and forget. So every time that the money comes in from the paycheck, it's kind of a bit towards we're saving for a house right now. So a bit for a house deposit. And then it's always paying myself first. So savings and then emergency fund top up if needed. And then just an automatic investment every single time. So it's like a set and forget. That's the most straightforward way to build wealth over the long term.
Fantastic. So that idea, I love that idea of just chipping away and putting a bit away each, week or fortnightly. Do you have a particular cadence that you suggest in terms of brokerage fees? Like, how does that work? What are the most sort of cost-effective ways to do it, I suppose?
Yeah, so that one, it depends on most importantly, how often you get paid. And then B, in terms of, so each brokerage platform is different. So that's why it's really important to know exactly what the fees are involved. So for example, some set a flat rate of $10, while some take a percentage cut. So let's just say like 0.5% of the amount you're investing. So if your brokerage platform does just charge a flat fee of $10, then it probably wouldn't be the smartest choice to invest $20 if it's going to take 20. So that's why it just really depends. But to what that I would say is first work out your budget, work out your cash flow and how much you can afford and how often you can invest. And based on that money, try to find a brokerage platform or one where the fees most align best with that.
Perfect. That sounds great. So, okay, thinking about the goal, how much you want to invest, and linking it to when you get paid and when it's going to make sense to, like you said, pay yourself first, but get it done so it's all automated. Wow. Sounds like a wonderful way to do it. And in terms of what other things beginners should look for when choosing a broker, so we've talked about fees. I know there are any other considerations to think of?
So I'm very time poor, or like I don't like to spend a lot of time trying to figure out how to use this app and whatnot. So ease of use is actually very, very important on my list, on my personal list when it comes to a brokerage platform. So in terms of how does the app actually look and feel? Is it very user intuitive? And does it have options for you to help automate your savings and your investing? So that's probably the key things that I look for, because for me, it's about making the whole process as simple as possible so that there's just less room to think about in terms of making emotional choices or poor choices. So that's why I just kind of make it as routine as possible. And then another thing which I personally look for or I really like is when a brokerage platform has good educational resources. So they might give you like tips in terms of how to best dollar cost average into the market, what's happening in the market as of now, and what are some investing strategies. Like that's the stuff that I look for.
You're speaking my language, Jessica. I wish I'd spoken to you about 20 years ago. But like you said, the best time to get started, if it wasn't 10 years ago, is today. So I'm going to go and jump straight on this after this call. This is fantastic. And on that note, how much money do you realistically need to start? Is $500 enough, or is that too much? Like, what do you need?
Well, the short answer to that is actually much less than most people think. So in Australia, you can start investing with as little as, I think you can even start investing with $50 with some micro investing apps. So the amount really starts there, or even as little as a few $100s. So it really depends on the platform. So on the brokerage platform and whether they allow fractional investing and what the minimum investing is. But really to that, it's whatever amount you can afford to invest in. So what matters more than the starting amount, I think, over the long term really is consistency. So are you topping up on it, being consistent and disciplined, and of course, time in the market. So what I always like to tell beginners is that you don't need to start big. You just need to take the first step and start investing.
Fantastic. And in terms of that beginning step as well, then, what would a good beginner portfolio look like? I know obviously it's linked to your own personal risk, as we've discussed, and it's personal. But yeah, some guidance on that.
So some areas for beginners to start looking at is we often say broad-based indices. So for example, ETFs that give you exposure to whole share markets. So for example, the ASX or the US, so S&P 500, the top US 100 companies, or like the A300 like we've mentioned before. So those are all good areas to start doing your research because it gives you broad exposure. And like we said, being broad, it helps mitigate the concentration risk, and it just gives you broad index exposure.
Yeah, fantastic. And more a personal question on this front too. I know that for my husband and I, ethical investing is really important in that mix. That's something that you can also do with an ETF though, I believe.
Yeah, it is. And so the top tip I would give when it comes to not just ethical, but any type of investing is to look under the hood. So what we mean by that is actually go onto the ETF issuer's website and have a look on the actual fund webpage. So for example, let's go back to A300. So you go to globalxetfs.com.au and then you type in A300 and you actually understand the index methodology or how it comes to build the fund. So ASX is just the largest 300 companies listed on the ASX, but in terms of, for example, the ethical fund is what do they actually consider as ethical? How are they actually implementing it in your portfolio? Are they doing negative screens? So that is, are they just not investing in certain companies or they're trying to achieve certain goals? So that's probably the best tip when it comes to like understanding what the ETF is actually doing is to look under the hood.
Okay, that's fantastic. So for me, for example, climate change is really important. So I want to invest in, I suppose, funds that are not in fossil fuels, but an ethical fund that might not be aligned with that, I suppose. So it depends on the makeup.
Yes,
so
and then
getting
some
alignment.
are very broad while some are more niche. So that's why it's very important to make sure that the one you're choosing aligns with everything that you want or everything that you're expecting from the fund.
Okay. Jess, I'm wondering if there's a beginner's mistake that you see all the time.
Yeah, so the first one or the top one, and I'm still guilty of this every now and then, is just checking your portfolio too much. Because like we said, you're investing for the long term. So does really the price move of like a day or a week really matter when we're talking total span of like decades here, right? And especially now when there's so much going on in the world and then there's so much market movements and volatility, it is very tempting to just kind of get in the hype of constantly checking, my portfolio is up 5%, yay, and then like, it's down 5%, and then that's how you start to get emotional and maybe make decisions based on emotions and not your actual investing goals. So that's the top mistake that I always see, which I'm so guilty of myself. So it does take a lot of time and discipline. I'm just being very clear.
That makes me feel really good, Jess, because it turns out being a bit of a slack investor once it's set up is okay in your books.
Yeah, for sure. But
that you don't
need to set and forget, put it in the drawer, and then come back 30 years' time. That's probably one of the best approaches there is.
Set and forget. And Jess, another question, just with ETFs, I know that obviously a normal share might pay a dividend. Do ETFs pay a dividend as well, or is it different?
Yeah, so ETFs, we call that a distribution. And how the mechanics of that work in an ETF is that, for example, going back to A300, we have 300 companies, and not all the 300 companies pay a dividend, but even if they do, they don't pay it on the same day. So how an ETF distribution works is that you can check this on the fund page, is that it usually pays it out either quarterly or semi-annually. So we just set a set day, so going every quarter or every June 30, what we're going to do is we're going to collate all the dividends that the underlying shares have been paying throughout this time period and then redistribute it back to you as the investor.
Fascinating. And so when you go to invest in a fund, could it give you an estimation of what that might look like, or is it always going to be different? How do you know?
Yeah, so we can't project. You can project, but it's never guaranteed that even though a fund or a stock has paid, let's say, X dollars before, that you'll keep continuing paying X. But the fund webpage will always show you what previous distributions have been.
Great. Is it a case that, like a normal share, you can get that back in shares or in cash, or is it one or the other?
Yeah, so then with ETFs, there's an additional kind of structure to it in the sense that when you buy an ETF or invest in an ETF, you can elect to whether have your DRPs reinvested for you. So that is a dividend or distribution reinvestment plan. So once you tick that box, when you do invest in an ETF, what that means is that the ETF issuer or myself, that would actually reinvest the dividends that the ETF gives back to you. So let's just give a very simple example. Let's say A300 pays a distribution of $10 in cash. So there's two options for you then. So you can either receive the $10 in cash in your brokerage account so that you can either withdraw the cash or reinvest it yourself, Or if you've elected for DRP, then what that means that is me as the ETF issuer I will go and invest the $10 back into the fund for you. So there's pros and cons to both, but then the main pro is that there's cost savings and you don't need to worry, and then I do the reinvesting back for you as the ETF issuer.
Okay, great. So just to summarize that if you're listening, and because this is in the weeds of how it works, but basically you can get a dividend back with a fund like you would with some shares. You could get that in cash, off you go, take it, use it however you wish, or it could get reinvested back into the fund for you under your allocation. Okay.
Yes.
Fantastic. Well, Jess, I've got one final question to finish today with. If you could go back to your 25-year-old self, what would you tell her?
Tell her just to start investing, and then don't worry about, buying all those outfits that you're only going to wear once and forget about. Just imagine all the money that you could have sitting in your brokerage account 10 years from then when it's through compounding. It doesn't take much to begin with. So it might just be $50 here and there, but all that adds up over the long term. And to my 25-year-old self, I would say, just start.
Just start. What a great note to finish on, Jess. Thank you so much for your time and sharing your incredible expertise with the wonderful Ladies Finance Club community. And that's going to be my biggest takeaway today. Just start. Start small, just start.
Start small and stay consistent. It's not about being perfect. It's just about taking the first step.
Thanks so much, Jess, and happy investing if you're out there getting started.
Thanks for having me. Happy investing.